David R. Guttery is an investment advisory representative of Ameritas Investment Corporation and president of Keystone Financial Group in Trussville, Alabama. Please stay tuned through the end of the video for additional important disclosure information.
Today I am joined by David Guttery, president of Keystone Financial Group in Trussville, for a discussion about how election results can impact the economy and the market. David, in our last video, we discussed how you address the financial uncertainty that can result from an election with your clients. I believe our viewers would like to know more about how such changes in the political landscape might impact the economy and the market.
Legislative actions and administrative policies can have a direct impact on the economy. For example, if lending regulations are exceedingly tight, then corporations will be reluctant to spend at normal levels in favor of retaining reserves. Likewise, uncertainty about cash flow that are related to congressional actions, such as the Affordable Care Act, can also exacerbate a reluctance to spend money at normal levels. If corporations aren't spending, then economic growth is tepid, employment gains are marginal, and it can make for a challenging investment environment.
So David, what impact might economic and political changes have on specific areas of the market?
When corporations hoard cash, then the velocity of money is slow. Inflation is rarely a concern in a slow velocity environment because generally the economy is sluggish and tepid due to the lack of spending. We normally find a strong dollar in such environments, and such is a disadvantage to international trade for U.S. domestic companies that are selling products overseas. Economic conditions like these will generally favor the large to the mega cap value, slow growth, dividend-paying equities, bonds, and real estate investment trusts, among other rate-sensitive classes of assets. Growth assets typically do not fare well in such environments. However, an election cycle can completely change economic expectations and also the disposition of the market. For example, when lending restrictions are relaxed, then the 10-year Treasury yield begins to rise on expectations of inflation and of higher spending. Also, expectations grow for administrative policies to be rescinded that had previously compelled corporations to hoard cash. The velocity of money increases, and we hear of better than expected employment results from the Labor Department. Consumer and corporate confidence metrics begin to rise. As these and other developments unfold, then the environment for growth assets becomes more lucrative than for value assets. Economic conditions like these generally favor growth equities of all capitalization sizes and also specific rate-sensitive sectors such as banking, energy, and real estate. We might also observe narrow channels of larger market segments where corporate spending has been significantly below normal for an extended period of time, and this might present an attractive investment opportunity as economic assumptions change. Process automation technology would fit into that category today. Real estate investment trusts that are highly levered are generally not attractive in a growth economy with higher inflation, and neither will such conditions be favorable to high-duration bonds, bond funds, or slow-growth mega-cap dividend-paying equities.
So, along with other responsibilities, you are there to monitor changes to the economic and legislative environment and help your clients align their investments accordingly. Is that correct?
That's correct. Successful long-term, objective-driven investing is much more a function of time, asset class selection, discipline, and patience than it is about market timing. Said another way, for most, it is best to strategically manage a portfolio rather than to tactically manage a portfolio. Now, that doesn't mean that investors shouldn't be proactive when it comes to seminal shifts and points of inflection. For example, since the election, we have maintained exposure to large cap risk assets within the portfolios of clients for whom such risks were objectively suitable. We just hold a different proportion of those assets on the growth side of the style box today rather than on the value side, now that we have a completely different economic outlook. We shifted to assets that will likely perform well in the new environment, in other words, and that is a strategic shift rather than employing a tactical shift of abandoning growth assets altogether in favor of other asset classes like bonds or cash. Some clients are more involved in the management of their portfolios than others, but all clients have one thing in common. They do what they do for 40 to 50 hours per week, and I serve as their investment advisor. So while they're busy being engineers, and attorneys, teachers, and doctors and such, they're relying on me to monitor the market and economic conditions for changes that could be beneficial or detrimental to the success of an objective-driven plan. My job is to understand the economic financial physics of cause and effect and help clients to navigate that environment.
Thank you, David. For additional information, David may be reached through the means listed upon the following screen. For the Trussville Tribune, I'm Tana Friday.
David R. Guttery independently offers securities and investment advisory services through Ameritas Investment Corporation, member FINRA and SIPC. AIC and Keystone Financial Group are not affiliated. Additional products and services may be available through David R. Guttery or Keystone Financial Group that are not offered through AIC. Some of the products and concepts discussed have their own cost and are subject to risk, including the possible loss of principal. These costs and risks will be thoroughly discussed with you prior to any recommendation or solicitation. Past performance is no guarantee of future results.